Welcome to S&P Capital IQ's November Loan Market Overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll highlight recent trends in the market and talk about the outlook for leverage lending as the year winds down. For real-time updates on the loan market, please follow us on Twitter, Facebook, and LinkedIn, or you can check in with us on the web. As well, you can download this presentation at slideshare.net. Loan prices caught a bid in October. Bolstered by improving technical conditions and better tone across the capital markets, the average price of LCD's flow name composite, shown here, ran up about 4 points to 95 over the course of the month. Rising prices lifted the S&P LSTA index to a 2.9% gain in October, the most in nearly 2 years. That was enough to push returns in the year-to-date back into the black at 1.5%. As this chart shows, the loan market took its cue in October from the broader capital markets, which rallies as concerns over Europe waned and the U.S. economy posted a solid 2.5% growth in the third quarter output. Improving loan technicals also helped the cause in October. During the month, outflows from loan mutual funds slowed to $950 million, according to Lipper FMI, from $2.7 billion in September and a record $5.5 billion in August. At the same time, 2 new CLOs printed, adding $815 million of additional demand. On the supply side of the ledger, the stock of institutional loans outstanding grew by just 0.5%. The primary loan market also strengthened in October. The average new issue clearing yield narrowed about 20 basis points from September's 2-year high reading of 8.1%. Loans that cleared at month end and in early November were even tighter, with single B paper clearing in the mid 7% range, down from 8.5% on average a month earlier. For double B paper, meanwhile, muscular demand from banks, CLOs, and insurance companies kept the average new issue clearing yield in the low 5s. Looking ahead, the outlook for new issue supply is lackluster at best for the balance of 2011 and into January. Certainly, the calendar of M&A loans has shrunk to recent lows, and arrangers expect just a trickle of opportunistic deal flow as the year winds down. As for demand, the X factor is the direction of retail flows, which are governed by the always unpredictable animal spirits. Where the loan market's technical situation has been in flux, fundamental conditions have been rock solid. Default rate, shown here, fell in October to a multi-year low of just 32 basis points. Looking ahead, managers expect a small increase in 2012, though without much in the way of loan maturities due over the next 18 months, the rate will likely remain inside the historical averages for the foreseeable future. A couple of final points. The window for new CLOs reopened a crack in October after slamming shut in the summer when the capital markets were reeling. Through that narrow space, a limited number of managers, perhaps 25 in all, can thread a deal. In October and early November, there were 4 such vehicles printed. The managers in question were Credit Suisse Asset Management, Sankaty, Guggenheim, and Welsh Carson Fraser Sullivan. New issue activity will be slow going during the final leg of 2011, arrangers predict. There was simply little in the way of underwriting in the fall, and therefore the cupboard is sparse. Looking out to the first quarter, participants expect a modest pickup in LBO and opportunistic deal flow if demand hangs in there. The final point here is obvious. The fortunes of the loan market today are closely aligned with the direction of Europe's sovereign debt crisis, which appears to be the driving force behind sentiment across the capital markets. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download this presentation at slideshare.net.